Imagine you're driving down this really winding, unfamiliar mountain highway in the pitch black of night.
Oh man, that sounds completely terrifying.
Right. It's pouring rain, your headlights are super dim, and there are literally no painted lane markers on the asphalt. Not a single white line.
Yeah, you'd just be white-knuckling the steering wheel the whole time.
Exactly. You're just reacting blindly to every single bump and sudden curve. You're completely stressed out because, well, you have no earthly idea where the safe center of the road is.
Let alone where the cliff edges actually are.
Exactly. And frankly, that's a perfect analogy for how most new retail traders approach a financial chart.
It really is. I mean, they open up their brokerage account, they stare at the screen, and they just see this chaotic, jagged line violently ticking up and down.
With zero context for what they're actually looking at.
Yeah, they're essentially driving in the dark, just reacting emotionally to every green and red candle that flashes.
But what if suddenly the storm clears? High-powered streetlights flick on, and bright, highly reflective lane markers are instantly painted right onto the asphalt.
That changes everything. Suddenly you see the actual structure of the road.
Right. You know exactly where to cruise comfortably, where to tap the brakes, and where the concrete guardrails are.
You stop reacting out of sheer panic, and you start navigating with a plan, a mathematical plan.
And providing those boundaries is exactly what we're doing today. Welcome to the Deep Dives. We are talking about pivot points.
We're basically going to paint those reflective lane markers directly onto your trading charts today.
We really are, and we have an incredibly dense, highly technical stack of source material to help us decode all this.
Yeah, we're pulling from some serious institutional broker guides, specifically IFCM South Africa and IG International.
Plus, we've got a fantastic Schwab coaching webcast focused entirely on trading futures and an F-Scouts technical tutorial.
And my favorite part, we're actually going to look under the hood at the raw computer code itself.
Oh yeah, we're breaking down the logic of TradingView Pine script indicators, specifically the kill zones plus ACD script and the multi-time frame indicator scripts.
The breadth of this material is just phenomenal. I mean, it bridges this massive gap between high-level market psychology and the rigid math of trading algorithms.
So our mission today is simple, but the scope is massive. We're going to equip you, the listener, with a step-by-step understanding of how to calculate, plot, and trade pivot points.
And we're totally bypassing all that vague financial jargon. We just want to hand you the exact structural setups.
Right. The non-negotiable risk management tactics and the psychology you need to stop chasing impulsive, FOMO-driven breakouts.
Because that transition from amateur to professional, it starts right here.
Let's unpack that immediately. When we talk about the math of this invisible battleground, the sources place a massive emphasis on predictive versus lagging indicators.
Oh, absolutely. The Schwab coaching webcast makes a huge deal out of this.
So why is a standard floor pivot point considered predictive? Like, why does that distinction even matter?
Well, it's basically the foundation of technical analysis. Think about the tools most new traders slap on their charts on day one.
You mean like moving averages or the MACD?
Exactly. Or Bollinger Bands. Those are all mathematically classified as lagging indicators.
Because they just take historical data and smooth it out into a line, right?
Yeah, they're essentially a mathematical exhaust pipe. They just show you the path the vehicle has already taken.
They're looking entirely in the rearview mirror.
Right. If a trend started 10 minutes ago, a moving average will eventually curve up and say, hey, a trend started 10 minutes ago.
Which is incredibly frustrating. By the time it gives you a buy signal, the institutional money has already been in the trade for ages.
And you're just buying their scraps at a premium. But a floor pivot point operates on a completely different philosophy.
This is the old school math, right? From the trading pits in Chicago and New York.
Yeah, exactly. Guys were calculating these on napkins before computers even existed. And it's predictive because it's calculated before the market even opens.
Or, if you're in the 24-hour forex or crypto markets, it resets when the daily session rolls over, like 5:000 p.m. Eastern.
Right. So before a single trade is executed in the new session, the pivot point has already projected this rigid grid of levels into the future.
It doesn't trail behind the price at all. It just sits there waiting for the price to approach it.
Exactly. It bases everything on the absolute extremes of the previous session.
Let's actually get into the machinery of that calculation because the IFCM guide breaks down the classic 5-point formula.
It's surprisingly simple math, honestly.
It really is. It all revolves around the anchor, the central pivot point, which we'll call P.
Right, the absolute baseline.
And the formula for P is just the high plus the low plus the close of the previous session divided by 3.
Yep. High plus low plus close divided by 3.
But my immediate question when I first saw this was, why those three specific points? Like, why completely ignore the open price?
Oh, trying to include the open is such a common rookie mistake. People are always trying to reinvent this formula.
So the open doesn't matter.
Not for this. The open is just the starting bell. It's where the first transaction happened based on overnight news. It's just noise.
Ah, okay. But the high, low, and close tell the actual story.
Exactly. They tell the complete violent story of the battle between buyers and sellers for that whole day. The high is the absolute maximum power of the bulls.
It's the highest price they could push it to before sellers overwhelm them.
Right. It's the point where the market universally agreed, okay, this is way too expensive.
And the low is just the inverse of that, the absolute maximum power of the bears.
Exactly. The deepest trench they could drive the price into before buyers stepped in and said, wow, this is a great value, let's buy.
So the high and low define the total physical boundaries of that 24-hour battlefield.
Yeah, but then you have the close. And the sources treat the closing price with, like, a sort of reverence.
Yeah, why is the close the most vital piece of the three?
Because it's the final, exhausted compromise. Think about the chaos of a trading day. Panic selling, short squeezes, algorithms going crazy over news.
But eventually, the bell rings.
Right. And the institutions have to reconcile their books. The close is the exact price where everyone finally agreed to settle the value of that asset.
So by adding the bullish extreme, the bearish extreme, and the final settlement, then dividing by 3.
You mathematically isolate the true, undeniable center of gravity for that market's sentiment.
The center of gravity, I love that visualization. So that P line is our baseline for the new day.
And the IFCM guide has a very strict rule of thumb for it.
Right. If the market opens and trades above that central pivot point, the inherent sentiment for the day is bullish.
Because the buyers retain control from yesterday.
But if the price is hovering below the central pivot point, the underlying sentiment is bearish.
The sellers are driving the vehicle. It's the ultimate line in the sand.
So if you literally do nothing else but use that central pivot to determine your bias,
Like refusing to take short trades if you're above the pivot?
you instantly eliminate a massive percentage of bad trades.
Absolutely. But P is just the anchor. From there, the formula projects support and resistance levels outward.
The classic R1, R2, S1, and S2. Let's walk through that math because understanding the geometry really helps you trust the lines in a live trade.
Yeah, let's break down R1, or resistance 1.
The formula is the central pivot point multiplied by 2 minus the previous day's low.
Right. And for support 1, or S1, it's the pivot point times 2 minus the previous day's high.
I gotta be honest, when I read this in the FX Scouts tutorial, it felt super counterintuitive.
It does sound backwards at first.
Yeah. Why am I subtracting yesterday's basement floor to calculate today's ceiling?
You have to visualize it as a projection of proportional energy. You have your new center of gravity, P.
Okay, I'm with you.
By doubling P and subtracting yesterday's absolute lowest point, you're estimating how high the bulls can push today.
Assuming they have the exact same relative strength as yesterday.
Exactly. You're saying if we start from our new center and push up with the same force it took to escape yesterday's depth.
Where does that upward momentum run out of gas?
Bingo. That exhaustion point becomes the R1 ceiling.
Oh, that makes perfect sense. You're projecting yesterday's upward force onto today's baseline.
And the inverse applies to S1. You double the center and subtract yesterday's highest point to project the downward force.
It calculates where sellers will run out of ammo today based on how hard they were rejected at the top yesterday.
It creates this perfectly symmetrical inner channel around the center of gravity.
Okay, but then the F-Scouts tutorial gets into the outer bands, R2 and S2, and the math shifts here.
Yeah, it becomes about total range. For R2, it's the pivot point plus the high minus the low of yesterday.
And S2 is the pivot point minus that same high-low range.
The high minus low gives you the total distance traveled yesterday, the absolute size of the battlefield.
So you're literally just taking yesterday's maximum volatility and stacking it on top of today's center of gravity.
Exactly. So if the price actually reaches R2 or S2, it means the market has replicated the entire maximum volatility of the previous day.
Which requires a massive amount of institutional capital.
It's an extreme expansion. Reaching those outer bands is a huge deal.
All right, I'm going to play the skeptical learner here for a second.
Go for it.
We just did the math. It's literally primary school arithmetic. Addition, subtraction, maybe a little multiplication.
Napkin math.
Right. So if it's this incredibly simple, why doesn't everyone just place a buy order at S1, a sell order at R1, and retire to a private island?
The ultimate question.
Seriously, if these mathematical lines are known to everyone, Why don't they work perfectly 100% of the time?
Because that mathematical simplicity is highly deceptive. You have to realize these lines aren't concrete physical walls.
Right, there's no actual force field at R1 stopping the price from ticking higher.
Exactly. They work because of the psychological phenomenon of the self-fulfilling prophecy.
Meaning they work because everyone believes they work.
Yes, a concentrated percentage of market participants program their trading behavior around these exact coordinates.
And we aren't just talking about a few guys in their basements on Reddit.
No, we're talking multi-billion-dollar institutional algorithms, high-frequency bank desks, global liquidity providers, the big money.
The entities that physically move the market.
Exactly. When hundreds of billions of dollars are programmed to view S1 as a heavily discounted buying zone, the market naturally reacts there.
Because the volume of orders physically bottlenecks at that price.
The lines are just invisible reference points. The actual barrier is the tidal wave of buy and sell orders waiting at those coordinates.
So it's not the line, it's the traffic jam of money at the line.
Precisely. The reason amateurs lose money is they blindly place a limit order exactly on the line and walk away.
They assume the line itself is a magic trampoline.
Right. They don't stick around to see if the traffic jam is a minor fender bender or a massive multi-car pileup that's going to destroy the market.
Which perfectly brings us to how we actually behave when price hits these lines. The broker guides outline three main interactions: bounces, breakouts, and reversals.
Let's use a physical analogy. Imagine you're standing in a room. The floor is S1, the ceiling is R1.
Okay, and the current price is a tennis ball.
Exactly. Normally, if you throw a tennis ball at the ceiling, what happens?
The drywall absorbs the impact, and gravity makes it bounce back down to the floor.
That physics concept translates directly to the bounce strategy, the bread and butter of trend trading.
You wait patiently for price to retrace to a mathematical barrier like the pivot point, or S1, and trade the bounce in the direction of the trend.
The IG International Guide has a great chart walkthrough for this, an hourly chart of the USD traded against the Canadian dollar.
USD CAD.
Oh,
And the
just-
broader trend was clearly bullish, right?
Yeah, moving steadily up. But the market breathes, it dips.
So on the hourly chart, you watch the price drift down toward the daily central pivot point.
And this is where observation is key. As those red candles get closer to the pivot line, you physically see the momentum dying.
The candle bodies get smaller. They turn from long red rectangles into tiny squares.
And you start seeing long wicks protruding from the bottom, piercing the pivot line but snapping back up before the hour closes.
Just like the tennis ball compressing against the floor. But the floor holds.
That visual compression is the exact signal. The sellers tried to break the center of gravity and failed.
Every time it dipped below, buyers flooded in and pushed it up.
Right. So once that hourly candle closes and confirms the floor is solid, buyers seize total control, enter their long positions, and push the price up to challenge R1.
And this happens in crypto all the time too, right?
Huh.
Like with Bitcoin.
Oh, constantly. If you pull up a 15-minute chart of BTC during a solid uptrend, you'll see it retrace down to a daily pivot, wick heavily, and just violently bounce back up.
Because the institutional crypto bots are totally programmed around these levels. You aren't catching a falling knife, you're waiting for the math to prove the floor is solid.
Exactly. It removes the guesswork.
Yep.
But the tennis ball doesn't always bounce cleanly.
Sometimes the market has massive momentum. A huge news shock hits, and institutions flood the market.
In that case, you throw the ball so hard it smashes right through the drywall ceiling into the room above.
That's the breakout strategy. When price violently and convincingly shatters a resistance or support level.
And convincingly is the operative word. We're not talking about a quick wick poking through R1.
That's just noise.
Right. A true breakout requires full, thick candle bodies closing definitively beyond the mathematical level, ideally on a higher time frame like the hourly.
When R1 shatters like that, it signals a massive shift in sentiment. The bears defending that ceiling just got completely liquidated.
And the fascinating part is, old resistance invariably becomes new support.
Right. The shattered ceiling becomes your new floor. Traders wait for a slight pullback to retest that broken R1 line, and they buy there.
But the IG guide also shows what happens when a breakout fails. They call it a rejection or a failed support breakout using an hourly AUD-USD chart.
Okay, set the scene for that one.
The day started optimistic. Price moved above the central pivot early on. Buyers felt confident.
But they couldn't hold altitude. The price started bleeding out, drifting back down to retest the central pivot from above.
The early buyers are desperately hoping the line acts as a floor, but the downward momentum accelerates.
A huge red hourly candle slices cleanly through the pivot and finishes with a close significantly below the line.
The structural floor totally collapsed, and for an observant trader, that specific failure is massive intelligence.
It tells you unambiguously that the buyers are totally exhausted.
Right. They couldn't defend the center of gravity. That close below is a strong technical signal to flip your bias, enter a short position, and ride the momentum down.
Okay, so we have the bounce and the breakout. But what about the extremes? When price ignores R1 and just keeps running to R2 or R3?
That's where you look for the reversal strategy. It's difficult, but highly lucrative.
Because markets have to breathe. They can't move aggressively in one direction forever.
Exactly. By the time an asset hits R3 or S3, it has traveled a statistically improbable distance.
The rubber band is stretched. So far, it's vibrating.
Right. If price is crashing and hits S3, practically everyone who wanted to sell has already sold. They're out of ammo.
There's no one left to push it lower.
So professional contrarians wait like vultures at these outer bands. They look for volume exhaustion like doji candles or massive wicks and catch the snap back to the mean.
The IG guide showed this beautifully with the FTSE 100 index during a macro uptrend. Amateurs just randomly buy whenever it's green out of FOMO.
But the pro waits. They watch it surge to an extreme, run out of breath, and bleed out for hours back down to the daily pivot, or S1.
And every time it hits S1 during that uptrend, buyers flood back in.
It demonstrates scaling in, adding to winning positions at calculated mathematical support rather than chasing extended rallies.
You see this in gold all the time too, don't you?
Oh, gold respects pivots incredibly well. A gold reversal at daily S2 with a massive exhaustion wick is one of the highest probability swing setups you can find.
That disciplined patience is everything. But, as I was digging through the raw Pine script code from the TradingView sources, I had a realization.
With that,
Not all institutional algorithms use the exact same math. The standard floor pivot is the classic, but there are entirely different evolutionary branches.
yes, advanced flavors like Camarilla, Woody, and Fibonacci variations.
And it's crucial to understand these aren't necessarily better than standard floor pivots.
Right. They're just highly specialized tools. Think of standard floor pivots as all-weather tires, good for most conditions.
But if you're driving into deep mud or onto a slick racetrack, you need specialized rubber.
Exactly. Let's look at the mud tires. Camarilla pivots.
The formula for Camarilla in the TradingView script looks terrifying. It plots 8 distinct levels, all clustered incredibly tightly around yesterday's close.
It uses a heavy multiplier.
Yeah, you take the previous day's high minus the low, multiply that range by exactly 1.1, and then divide it by 12, 6, 4, and 2 to create the bands.
It sounds like arbitrary voodoo math.
It really does.
Yeah.
Why should I trust a trade based on dividing a random number by 12?
Well, you have to look at the problem the inventor, Nick Defrost, was trying to solve in the 80s. He was a bond day trader. And he realized markets only trend heavily maybe 20 to 30% of the time. The rest of the time, they're just chopping sideways in low volatility ranges.
The dreaded sideways chop that destroys trend traders.
Exactly. Defrost found that in a sluggish market, standard floor R1 and S1 lines were plotted way too far away. The price never reached them.
So the indicator was useless for that day.
Right. He needed a tool to capture micro volatility. That 1.1 multiplier and those specific harmonic fractions are engineered to drastically compress the lines.
It basically takes the ceiling and the floor and crushes them into a tiny room.
Like a tightly coiled mathematical spring. So a scalper in a sideways market gets these immediately actionable, tightly packed Camarilla targets to ping-pong between.
That makes total sense for a day trader. But then there are Woody pivots, which are completely different.
Woody totally departs from the standard math.
The Woody P formula takes the high plus the low plus 2 times the close and divides the whole thing by 4.
It places a massive double-weighted emphasis entirely on the closing price.
What does that physically do to the line on the chart?
It violently yanks the center of gravity away from the extremes and pulls it tightly to the final end-of-day reality.
Because Woody traders believe intraday highs and lows are often just irrational emotion and noise, right?
Exactly. They view the extremes as panic spikes, but the close is the final audited institutional settlement.
So Woody ignores the midday spikes and creates a much more conservative set of levels.
It's a completely different narrative on the chart.
And finally, we have Fibonacci pivots, which feels like a bizarre crossover between two technical analysis religions.
It really is a synthesis of two massive concepts.
It takes the standard floor pivot point high plus low plus close divided by 3. But for the support and resistance lines, it applies strict Fibonacci retracement percentages to yesterday's range.
Right, like 38.2% or 61.8%.
Why blend these two?
Well, the standard pivot gives you an undeniable center of gravity based on yesterday's reality. And Fibonacci numbers are these universal mathematical constants found in human crowd psychology.
They statistically dictate how far a trend naturally retraces.
So combining them caters to traders who want predictive daily math, merged with the natural retracement geometry that massive algorithms are already programmed to buy at.
Okay, I get the logic.
Right.
But as a learner, if I plot standard, Camarilla, Woody, and Fib levels all on one chart, it's just going to look like a wall of neon spaghetti.
Oh, absolutely. You wouldn't even see the candles.
How do I choose without second-guessing myself?
The wall of spaghetti is a massive trap. Novices think more indicators equals more accuracy. It just creates conflicting signals and analysis paralysis.
So how do you choose?
You never plot them all at once. You choose one framework that aligns with the macro market condition and your specific trading time frame.
Give me an example.
If the daily chart has been shopping sideways for 3 weeks, you load up Camarilla to exploit those tight ranges.
But if the Fed just cut interest rates and the market is exploding in a massive bull run,
Camarilla will get you crushed. You strip the chart, apply standard or Fibonacci pivots, and catch the deeper structural pullbacks.
adapt the math to the terrain. I love that. Which brings us to a huge point. Understanding the math is only half the battle.
You can have the perfect map, but if you don't know what time the gates open, you'll still lose.
Exactly. Let's talk about the clock, the step-by-step setup focusing on multi-time frame analysis and kill zones.
The Schwab webcast emphasizes mapping multiple time frames simultaneously.
Let's start with daily versus weekly pivots.
Time frame alignment separates amateurs from pros. A daily pivot is highly reactive. It gives you the granular context for today's intraday noise.
It tells you where the localized battles will be fought over the next few hours. But the IFCM source notes that daily forex pivots use a 24-hour cycle. That's a short, noisy window.
Extremely noisy, which is exactly why you must mathematically map weekly pivots onto your chart too.
Weekly pivots zoom way out. They take the absolute high, low, and close of the entire previous week.
5 full days of massive institutional positioning, hundreds of billions of dollars. Weekly pivots act as undeniable gravitational pulls.
So if a daily pivot is a local stop sign, a weekly pivot is a reinforced concrete roadblock on the interstate.
Spot on. Swing traders rely almost exclusively on weekly pivots, but the real magic is confluence.
Like when time frames align.
Yes. If you're day trading a 15-minute chart, and your daily R1 line sits at the exact same coordinate as the broader weekly pivot point,
That level is exponentially more powerful.
it's massive.
Yeah.
But even with the roadblocks mapped, you need to know when to trade them. The forex and crypto markets are 247.
You physically can't stare at a screen for 24 hours.
This is where kill zones are critical. The TradingView sources detail this extensively. The volume is not distributed equally.
Let's break down the math of these windows. You have the Asia kill zone from 23.00 to 03.55 UTC, Sydney and Tokyo banks.
Yep.
The London kill zone from 07.00 to 09.55 UTC. And the New York AM kill zone from 14.30 to 22.55 UTC.
Right. And those specific windows dictate success because volume is the only fuel that validates the pivot math.
A line is useless if there's no money to interact with it. Going back to the driving analogy, kill zones are like rush hour traffic.
Exactly.
If you put a roadblock on the highway at 3 a.m., deep in the Asian session, outside a kill zone, what happens?
A few stray cars might tap their brakes and quietly drive around it. No pileup, no reaction.
The price might just lazily drift through your support line on low volume, trapping you in a fake breakout.
But if you drop that same roadblock on the highway at 8 a.m. during the peak London kill zone rush hour,
It causes a violent pileup. Thousands of cars hit it at once. Volatility spikes massively.
that is precisely when institutional algorithms actively defend or attack those levels. A daily pivot in the London session carries 10 times the weight of one in the quiet hours.
The TradingView source also dives into the ACD methodology, designed to be used with these kill zones.
The ACD method is fascinating, built by a highly successful commodities floor trader.
It's built on the statistical significance of the opening range. Explain how that integrates with our pivot lines.
The algorithm basically says the first 20 to 30 minutes of a session, like the New York Open, dictates the emotional tone for the whole day.
So it looks at the high and low of that chaotic first 30 minutes.
Right. And it calculates A points slightly above and below that range, the A up and A down lines.
Okay, visualize the New York kill zone opens, the bell rings, the market goes crazy, the script calculates an A up line just above that range.
If price surges and breaches that A upline, it's a highly reliable, volume-backed, bullish signal.
But the text says you have to wait to confirm it's not a fake breakout.
Right. The algorithm requires price to stabilize above the A upline for a set period, say half an hour.
It's like merging into the HOV carpool lane. You have to merge in with momentum and maintain your speed.
If you just swerve in and swerve out, it's a fake breakout.
But if that ACD A up breakout triggers at the exact moment, the price is smashing through your daily R1 line inside the New York kill zone.
That's a pristine high probability alignment. Pro traders wait weeks for those setups.
But all these roadblocks and HOV lanes are completely useless if you don't wear a seatbelt.
Now we're getting into the most critical part: execution, risk management, and psychology.
How do we actually pull the trigger without blowing up our accounts?
Execution has to be entirely mechanical, stripped of emotion. Before the session, mark your daily and weekly pivots. Highlight your kill zones.
Then take your hands off the keyboard and wait.
And then the hardest step. Wait for candle confirmation. Do not chase impulsive, ticking breakouts.
All the sources scream this warning.
It's the #1 account killer. You see a massive green candle rocketing toward R1, and your FOMO kicks in.
You feel the panic. It's going to the moon. I have to buy now.
The pro instinct is to sit on your hands and wait for the hourly candle to physically close above R1.
Because if it just violently pierces R1 and immediately retracts, closing below.
That's a bearish rejection. If you panicked and bought the tip of that wick, you're instantly trapped at the top of a losing trade.
Just providing liquidity to the institutions that sold it to you.
Exactly. To prevent that panic, the FX Scouts tutorial emphasizes confluence. Never use pivots in absolute isolation.
They give you the where, but not the why.
Right. You have to combine them with non-correlated indicators. Momentum oscillators like RSI, or long-term trends like the 200 moving average.
Paint a visual of that. Say an asset is rallying hard and hits my R2 line. I know it's a reversal zone. How do I know it won't just blast through to R3?
You check the dashboard. If price hits R2 and your RSI is reading 85, massively overbought and exhausted, and a descending 200 moving average is passing through that exact same coordinate.
That's true confluence.
Predictive geometry, momentum exhaustion, and historical resistance all screaming stop at the exact same decimal. That is an elite reversal trade.
Okay, I take a deep breath and I execute the short position at R2. Now, where does my stop loss go? This is where retail accounts die.
They die because they guess based on how much money they're willing to lose. But the pivot grid makes stop losses totally objective.
You place it structurally just beyond the next mathematical zone.
Exactly. If you're buying a bounce off the central pivot point, your thesis is that the pivot will hold as a floor.
So your protective stop loss goes just below the S1 line.
Because if price breaks S1, your underlying thesis was completely wrong. The floor collapsed.
You want the system to automatically eject you before S1 becomes S2 and you lose half your account.
The TradingView ACD script spells this out too. Enter long on an A up breach. The stop goes automatically below the A down line.
The math dictates the risk perimeter.
And you must adhere to reward to risk ratios. The ACD text demands a minimum 1-to-1 ratio. Many pro desks require 2-to-1 or 3-to-1.
You must mathematically know your profit target and your stop loss before you touch the mouse, which brings up the agonizing psychology of no man's land.
Oh, the vast, empty spaces between the pivot lines.
Where retail accounts go to slowly bleed out.
The spaces halfway between S1 and the central pivot have no mathematical edge. Institutional algorithms aren't fighting over the middle of the room.
There's a bold disclaimer in the IG guide. 71% of retail client accounts lose money when trading CFDs with this provider.
It's a sobering statistic.
And I guarantee a massive portion of those losses are from traders getting bored, sitting in no man's land, seeing a random green candle, and hitting buy out of FOMO.
With zero mathematical structure protecting them.
They're pulling over and stopping their car in the middle of the highway lanes.
It requires immense, unnatural discipline to sit at a monitor for 4 hours and do absolutely nothing. Pros act like snipers. They calculate wind speed, map terrain, set their scope at a specific pivot point, and wait.
If the target never walks into the crosshairs, they pack up and go home without firing a shot.
While amateurs spray capital blindly hoping to hit a trend.
I do have to ask a hard reality check question, though. What happens when a massive, unforeseen macroeconomic news event drops?
Like an emergency Fed rate hike or a sudden geopolitical conflict.
Yeah. Do these carefully calculated historical pivot points just get blown completely out of the water?
Yes. Extreme, unexpected fundamental volatility will shatter an S1, an S2, or even an S3 line like thin glass.
So the math becomes temporarily irrelevant.
Entirely irrelevant. Massive algorithms instantly pull their liquidity to assess risk. The order books thin out, and the price essentially teleports through the pivot lines.
Which is exactly why the rigid stop loss is non-negotiable. The math is a guide, not a guarantee.
Right. Pivot points provide a highly accurate framework for the 95% of the time the market seeks liquidity normally. But for that lingering 5% black swan chance, you must wear your seatbelt.
If an unexpected event shatters S2, your stop loss triggers. You take a painful but calculated 1% loss, and you survive to trade tomorrow.
Without the stop loss, you become part of that 71% failure statistic.
So as we rack up this deep dive, let's summarize what this all means for you tomorrow morning. Pivot points aren't magic.
No, they're the rigid mathematical architecture of the trading day, derived logically from the previous session's extremes.
By plotting standard, Camarilla or Fibonacci, pivots across daily and weekly timeframes, you create a structural grid. You paint those reflective lane markers.
And by fiercely guarding your capital, waiting for candle confirmation, only executing in kill zones, and setting objective stop losses, you stop guessing.
You stop reacting emotionally in no man's land and start reacting objectively to calculated market geometry.
It completely shifts your mindset from constant anxiety to cold, calculated anticipation.
But I want to leave you with one final, slightly provocative thought. If every major institutional algorithm, global bank desk, and hedge fund knows exactly where R1, R2, S1, and S2 are, down to the decimal.
It's the multi-million-dollar question.
Are these levels actually natural organic support, or are they mathematically designed liquidity traps?
Where big players know millions of retail traders will predictably place stop losses.
Right, allowing institutions to deliberately drive price into those zones, trigger the stops, and absorb that retail liquidity for their own massive positions.
Which is why observing the behavior of the price at the line-reading fake breakouts and wicks is infinitely more important than the line itself.
You have to know if you're bouncing off a floor, or if the floor was a trapdoor all along.
It's a high-stakes game of chess played at light speed.
So as you pull up your own charts right now, what's your ultimate anchor going to be? Do you trust the localized daily pivots more for that quick intraday precision?
Or do you rely entirely on the massive, concrete weekly pivots for those undeniable gravitational setups?
Think deeply about your time frame, choose your math, paint your lane markers, and for the love of your portfolio, stop driving in the dark.